Welcome to the Explainer. If you've been glued to the foreign exchange charts lately, you've definitely noticed some serious upward momentum from the New Zealand dollar. But, to really understand what's happening here, we can't just stare at the raw numbers. We've got to peel back the layers and unpack the global and local forces that are actually pulling the strings behind the scenes.
Here's our roadmap for today. We're going to start with the Kiwis' winning streak, look at the China connection, and touch on a weakening US dollar before zooming out to look at what generally drives the Kiwi, and finally, the RBNZ and interest rates.
All right, let's dive right into Section 1, the Kiwis' winning streak and momentum in Forex.
So the New Zealand dollar has carved out a really solid 4-day consecutive winning streak against the US dollar. And if you follow Forex, you know that 4 straight days of gains is a big deal. It indicates strong, sustained momentum. Investors are actively moving capital into the Kiwi, and a multi-day trend like that tells us we aren't just looking at a momentary blip or a flash in the pan. There are actual, substantive drivers pushing this valuation higher.
Just to ground us in the hard data for a second, during Thursday's Asian trading hours, the pair was trading right around the 0.5920 mark. This specific level is our current baseline. But to figure out why it's holding there, we actually have to look across the ocean to New Zealand's biggest trading partner.
Which brings us to Section 2, the China connection, and its impact on the NZD.
There is a massive, direct correlation between Chinese economic health and the Kiwi's value. Recently released data for China's first quarter of 2026 showed a GDP expansion of 1.3% quarter over quarter. That's up from 1.2% at the end of 2025, perfectly matching expectations. Annually, China's GDP rose 5.0%, which actually beat the market expectation of 4.8%. Now, while retail sales were a bit softer at 1.7%, industrial production beat estimates, coming in at 5.7%. So what does this all mean for the Kiwi? Well, China is New Zealand's absolute biggest trading partner. When the Chinese economy expands, they buy more New Zealand exports. That influx of trade directly strengthens the NZD. It's just a perfect example of global economic interconnectedness.
Okay, Section 3, a weakening US dollar and shifting sentiment.
We have to look at the other side of the currency pair now. A major factor softening the US dollar right now is shifting global sentiment, specifically around geopolitics. There are rising market expectations of a potential de-escalation in Middle East conflicts. Recently, US President Donald Trump stated that the war was, quote, close to over. From a strictly objective market mechanics perspective, statements like this, alongside reports of ongoing ceasefire negotiations, drastically improve global market sentiment. When the world feels even a little bit safer, investors tend to move their money out of traditional safe haven currencies like the US dollar, which inherently weakens the greenback against pairs like the Kiwi.
Understanding this exact cause and effect chain is absolutely crucial. First, expectations of a Middle East de-escalation lead directly to easing energy prices because, of course, the Middle East is heavily tied to global oil. When energy prices drop, inflation concerns start to cool off. And that leads to tempered expectations for the Federal Reserve. With inflation cooling, the market anticipates the Fed will just hold interest rates steady this month and possibly for the rest of the year. All of that puts additional downward pressure on the US dollar.
Let's zoom out for Section 4, what drives the Kiwi? Here are the core valuation pillars. If you want to truly master the NZD, you need to memorize these 4 core pillars. First, as we just discussed, the health of the Chinese economy. Second, and I honestly think this is fascinating, dairy export prices. The dairy industry is New Zealand's main export. High global dairy prices literally boost national export income and strengthen the entire country's currency. It's amazing. Third, we have domestic macroeconomic data like growth and unemployment. And fourth, global risk sentiment.
That fourth pillar begs a really interesting question, though. How exactly does broader global risk sentiment impact the Kiwi? How does investor psychology halfway across the world move a currency in the South Pacific?
It all comes down to the classic risk-on versus risk-off paradigm. The New Zealand dollar is considered a commodity currency and a higher-risk asset. During risk-on periods when the market is optimistic and global risks feel low, investors are totally willing to chase higher yields. This strengthens the NZD. But conversely, during risk-off periods, times of economic uncertainty or market turbulence, investors panic. They sell off the Kiwi and flee to stable safe havens, which weakens the NZD. Understanding this psychological pendulum is key.
Finally, let's hit Section 5, the RBNZ and interest rates, and the central bank's role.
The Reserve Bank of New Zealand remains laser-focused on one main thing: their 1% to 3% inflation target window. Their mandate to anchor inflation right near that 2% midpoint dictates their entire interest rate strategy. Basically, everything they do revolves around this target, and when inflation drifts away from this window, they adjust rates to bring the economy back into balance.
Here is the mechanical effect of that. When domestic data runs hot, the RBNZ hikes rates to cool it down. That simultaneously drives up bond yields and attracts foreign capital, making the country really appealing to investors. On the flip side, weak data prompts lower rates, which drags the Kiwi down. It's a fundamental dynamic, for sure, but it remains the absolute strongest domestic lever acting on the currency's valuation.
So what should you actually take away from this explainer? It's the beautiful, complex, dual nature of foreign exchange. The valuation of the New Zealand dollar is literally an endless tug of war. On one side, you have local forces pulling the rope: New Zealand's domestic data, their dairy exports, and the RBNZ's interest rate decisions. But on the exact opposite side, you have these massive global tides pulling back: the economic engine of China, the shifting geopolitical landscapes in the Middle East, and the overarching psychology of global investors.
Which leaves us with this final, really provocative question to track moving forward. We know the so-called rate differential, how New Zealand's interest rates compare to the rates set by the U.S. Federal Reserve, is a massive driver for the NZD to USD pair. With the Fed expected to hold rates steady to temper inflation, and the RBNZ constantly monitoring their own 2% target, how will this interest rate gap widen or narrow in the coming months? Keep your eyes on that differential, guys, because it holds the key to the Kiwi's next big move. Thanks for joining me on this explainer, and keep learning.